Okay, so the earned income credit, this is kind of the granddaddy of the credits. This is a very generous credit for those who qualify for it. It is fully refundable. You do have, now you have to have earned income. So it can't just be like interest income or Social Security income or disability income or pension income or anything like that. It has to be earned income. So you either have to have received a W-2 or you've got self-employment income that is positive. So you can't, if you have self-employment income but it's negative, so you have a loss, you do not have earned income. So you have to have some earned income that was subject to Social Security and Medicare tax, essentially. It's designed to help working taxpayers who are lower income and to alleviate the burden of some additional taxes such as gas taxes and Social Security taxes, because it's refundable, you may not owe any income taxes. So it's not really a refund of income taxes, it's a refund of other types of taxes. The EIC, because it's refundable, it says it's kind of treated, the refundable credits, that refundable portion is as though you paid the money, as though you prepaid it, as though it was withheld from your paycheck. So it's kind of like it's treated like a payment towards your taxes that you then are getting back. So you don't have to have a qualifying child, but the amount of the credit increases up to 3 qualifying children, and then any additional qualifying children does not increase the credit. So it's a graduated scale, and you're going to see, I'll show you how it works. If you think of a table here, and this is income, and this is the credit, the amount of the credit. With 0 income, you get 0 credit. So this is, again, earned income. With 0 income, you get 0 credit. But as your income goes up, the credit goes up. Sorry about the squeak. And then we get to a level where it tops off. And it stays at that topped off level for a while. I'm sorry, I've got this backwards. I want the income down here and the credit down here. Over here. Earned income. Sorry. I got my X's and my Y's mixed up. So the credit amount tops off, and then as income goes up, the credit amount decreases until it reaches 0. So this up here, this is the maximum credit up here, and like I said, it stays here for a while. So one of the ways, and I'll tell you, one of the ways that people will commit fraud with this credit is they will make up income. They'll pretend that they have income that they don't have. Because if you notice, like if you were right here, I don't know what income level this is, let's just say it's $10,000. You would get this amount of credit. Let's just say this is $2,000 based on how many children you have. But if your income, if you could get your income up to here, and let's say that's $20,000, then you're going to get $7,000 credit. There's incentive to generate income that maybe might not otherwise exist. So this is one of those areas where people will actually add phantom income through self-employment income or through not taking expenses, because overall they're going to get a greater tax benefit by maximizing this credit. This is also why there's a lot of restrictions on it. And it's a very valuable credit. You'll see with the credit levels that we talk about here, it can be extremely valuable. And when you then double that with the child tax credit, because you can get both, and they're both have, earned income credit is completely refundable, child tax credit is partially refundable, and it's per child. If you've got 3 children and you get the full refundable child tax credit, so $1,700 per child, plus you're eligible then for the maximum earned income credit, we're talking $10,000 or more. There's a lot of motivation to maximize these credits. So there's also, knowing that, the IRS also spends a lot of resources in monitoring these and also in penalizing preparers who file returns that are fraudulent with regard to these credits in particular, these refundable credits. So you don't have to have a qualifying child. The credit amount is maximum credit increases based on up to 3 children. So your maximum credit for if you don't have a qualifying child, so like it would look probably more like, that's our income. It's going to be a flatter. So like no children, 3 kids. So going to be something along those lines. Not exactly, and when we look at the tables, you'll see what I mean by that too. You can see with the numbers. So it's determined by multiplying the taxpayer's earned income by an appropriate percentage. What's earned income? Wages, salaries, tips, earnings from self-employment. You do have to subtract the 1/2 of self-employment taxes from that amount. A taxpayer who has a net loss from self-employment must reduce earned income by the amount of the loss. So think about that. If you've got a side hustle, maybe you're a DoorDash driver or something, and you actually had a loss in DoorDash, but you also had a W-2 job, well, you might be incentivized to not claim some of those expenses on your DoorDash so that you don't have a loss, because that's going to affect your level of refund here for the earned income credit. For those of you who are signed up for VITA, we see this credit a lot. The population that we serve utilizes this credit a lot. Not all of them, not everybody, because we also have a lot of retirees, older folks, or people who just don't qualify for it. But just kind of a heads up, we see this a lot. We see a lot of child tax credit as well. We also see we do see self-employment income. A lot of them are delivery drivers who have self-employment income. So who's a qualifying child for purposes of the credit? Taxpayer must either have a qualifying child or meet certain criteria. Qualifying child is taxpayer's son, daughter, grandchild, or descendant, stepson, stepdaughter, or descendant. So when it says descendant, so not ascendant, or not what do they call those? Ancestor, but a descendant. Eligible foster child, so taxpayer cares for as their own child, who is also one of these brother, sister, stepsister, descendant of a person, brother, sister, stepsister, or a child placed with the taxpayer by an authorized placement agency. So it can't just be some random kid that lives with you. Your neighbor's kid who they don't want to take care of, or an adopted child. Child also must live with the taxpayer in the U.S. for more than half of the year and be under the age of 19, or a full-time student under the age of 24. They must be younger than the person claiming the credit, so just like that child tax credit, same thing. They cannot file a joint return other than to claim a refund. If the only reason they're filing a joint return is to claim a refund, then that's okay. They also have to have a Social Security number. So it can't be a taxpayer ID number or just not any number. They have to have a valid Social Security number. So again, for those who are gonna participate in VITA, I know that this is a lot to remember. They give us flowcharts to use to help determine whether somebody is a qualifying dependent, qualifying child for the earned income credit, qualifying child for the child tax credit, all of that stuff. They give us flowcharts, which are extremely helpful in making that determination. If there is no qualifying child, in order to be eligible for the credit, all of these criteria have to be met. So the taxpayer has to have a principal place of abode in the U.S. for more than half of the tax year. They have to be older than 24, but they have to be younger than 65. So retirees do not count, or those over age 65, before the end of the tax year. In the case of married individuals, at least one spouse must satisfy this requirement. So this is if you don't have a qualifying child. So you can be over the age of 65 and qualify for the earned income credit if you've got a child, adopted child, or maybe one of your grandchildren that you are caring for that meets those other qualifications. So it's not that you can never qualify if you're over that age. It's just if you do not have a qualifying child. They cannot be claimed as a dependent of another taxpayer, and they cannot be a non-resident alien for any part of the tax year. Okay. All right, so let's look at this calculation. There's also a table, which I'll show you. So what we do is we multiply the earned income up to a certain amount by a percentage. When the earned income exceeds certain levels, the credit begins to phase out. So here's our phase out here. The percentages for the credit and phase out amounts vary depending on filing status and the number of qualifying children claimed by the taxpayer. Okay? The appropriate percentages and earned income amounts are shown in a table. Let's see, is it on? There's our table right there. So it appears, and this table is a little bit confusing. Every year I have to remind myself of how it works as well. So bear with me here. So married taxpayers with two eligible children would use the column 2 here. And if they're married, so we've got joint filers and we've got all other filers. So if they're married filing jointly this, if they're not, we would use those phase out ranges. So for earned income up to $17,400, the taxpayer would be entitled to a credit of 40% of earned income. That would be the credit amount. For tax year 2024, $6,960 is the maximum EIC for a joint filer with 2 qualifying children. Now you can see if you have 3 or more, the maximum earned income credit is $7,830. So that's a hefty amount, especially if you've got 3 kids. You probably are qualifying for the child tax credit as well, and you've got 3 kids, right? So that combine that with the child, that's where we're getting into the $10,000, $11,000 sort of thing. So let's see if they've got an example here. So for married, so the phase out range starts, let's see, for earned income up to $17,400, then 40% of their earned income would be eligible for the earned income credit. I think that's how I'm reading it. Married filing joint returns with 2 qualifying children with earned income between $17,400 and the phase-out starting point of $29,640 are also entitled to the maximum credit. once earned income rises above $29,640, so this is where the phase out, the top phase out starts. Whoops. The EIC is reduced by 21.06% of the excess over that phase out until the earned income reaches $62,688. Then it is eliminated. All right, so what that means is, so I talked about this point here where we're at the maximum level. That is between, depending upon that income level, is between $17,400 and $29,640 with 2 children. Between those income levels, this would phase out. This would be our top range. So if I put this in graphical form here, this would start, and we'll use the 3 children. So between 17,400 here, and this would be 29,000 if this is for a joint filer. So this is only for married filing joint. It would be different phase outs for all other filers. And then it goes to 29,640. This is 0 here. This should go to 0. And then the top phase out is at 66,819. So this would be 66,819. So between 0 earned income with 3 children, between 0 earned income and $17,400 of earned income, you're going to get 45% of your earned income as an earned income credit up to the maximum amount. So that's why the lower your income, the lower that earned income credit is going to be, because it's based on a percentage of your earned income. Up to a maximum, I'm going to take this line out so we're not confusing it. So each filing status and each number of children would have its own chart like this, or its own graph like this. So this would be 7830. Up here would be our maximum credit amount. Just to kind of give you a little visual representation of what it looks like. And then it phases out, our phase out percentage, this downward slope phases out by 21.06%. Where is it here? Of the excess over that maximum amount. Okay. So let's see if we can get an example here. Again, this was for married filing jointly for 3 children. This is the form, and actually there's several pages to this form. You've got to enter all of this information. So you've got to have the child's name, the child's social security number, the child's year of birth, and then answer all these questions, yes or no. What is the child's relationship? How many months did they live with you in the U.S.? But the actual calculation of it is done on a separate form, which I guess they're not sharing with us. So let's look at this. So Danny and Wanda have 2 eligible children. All right, so 2 kids. So they're going to be here in this column, where the phase out starts at 17,400, ends at $29,640, but it's up to a maximum of $62,688. So let's look at the calculation here. What we do is we take the maximum credit, so $42.13. Where do they get the $42.13? Where are they getting the $42.13? Hold up. Oh, I was looking at the wrong. What was I looking at? Oh, I was looking down here. Sorry. So Matt will take the maximum credit of $69.60. So we get that from here. So $69.60. And then we're going to subtract, and this is because their income is over the phase-out amount. Then we're going to subtract 21.06% of the amount over that top of that phase-out range. So we'll subtract, so we'll take that maximum credit, $69.60, and then we're going to subtract 21.06% of the amount of their AGI, which they gave us here, 38,025, minus the top of that phase-out range, 29,640. I know that's for 3, but for 2, it's the same thing. It's the same phase-out starting points and ending points. 21.06%, which again, that comes from the table here. If it were one child, we'd be using 15.98%, and we'd be subtracting it from 4213. So we're going to subtract that. They get $5,194 as a child tax credit. We use the same information using there is a table. They have earned income of $38,025, falls between $38,000 and $38,050. All right, so let's look at the table here. Can we jump to the table? Okay, we'll jump to the table in a minute. There is a table, so it makes life a little bit easier, actually a lot easier. Another example, this is with one child, so they are married. We're assuming they're married. Doesn't really say they're married, but I guess we can assume that they're married. Not always an accurate assumption, but they have one child, so they're going to use this column here. So they'll take their maximum earned income credit, $4213, $4213, and then they're going to subtract their AGI minus that top phase-out number of 29,640 and take 15.98% of that. That's what they're going to subtract. So for one child, the maximum credit that you could get is $4,213. Let's see. I'll go to the table in just a second here. So you're ineligible. You can't take the earned income credit if you have disqualified income in excess of $11,600. Disqualified income would be defined as some type of passive income: dividends, interest, rental income, royalty income, capital gains, net passive income. So all of that combined, if it's more, even if you fall into the income ranges and you have the qualifying children, if you have disqualified income of $11,600 or more, or actually more than $11,600, you are not eligible for the earned income credit. Okay. A taxpayer with a qualifying child may receive advance payments of the EIC through their employer, not to exceed 60% of the total available credit. So you can do it through withholding as well. You can reduce your withholding and get it. But you can't, that advanced amount can't be more than 60%. Let me see if I can find the table here. Is that it? Nope, that's that. Oh, here we go. EIC tables, Appendix A. So this is actually a good way to illustrate how it starts at 0, which is over here. So this is your, so there's a worksheet to determine what the income range is over here. Once you've had, essentially that's like our modified adjusted gross income here that we're using. So depending upon filing status, so single, married, filing jointly, this table starts here, goes down to the bottom there, and then it goes over here. So it goes like this. It's several pages. So for example, let's look. I want to get to the maximum. I'll show you how it stays there. Okay. 7830. Okay, so for 3 kids, our range starts at 17,400, which it shows right here, 17,400, if you can see that. So the amount of the credit is $7,830. So that's where that starts. Below that amount, so at $17,350, you could see the credit would be $7,819. So it's an amount below that. So this is where it's gone up, 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 up. Now it's reached its max. You can see 7830, it stays at 7830. Well, it's still 7830 over here at these income ranges. These are only $50 ranges, so there's going to be a lot of 7830 still at these income ranges. It's going to stay there until we get to 29,640. All right, here we are. 29,650 on the table. So 7830. And then it goes down to 7823 once we get up to a higher income level. So that's where we start coming down here with the credit. Okay? You can use the table. It's not going to be as exact, right? So use in your homework, use whatever they tell you to use. If they specifically say to use the calculation, then use the calculation. I know it's kind of a complicated calculation. It's one of those things that you gotta do it a few times before you kind of get it down. But you can also use the table for that purposes. All right, so that's the earned income credit. Questions about that?